And let me get back to sharing the screen. All right. So today we're going to talk about understanding your naked financials. I think this is something that a lot of us know that we should take note of, but it's something that either many of us do not know where to get started, or it's a topic that we might find a little bit taboo, something that we don't even discuss with our spouse or our family members. So what I'm trying to do here is really to try to debunk that, and we can talk about financials quite candidly. And if you have any question along the way, feel free to drop up the chat box and type in your question. During the interval or a break time, I'll try to get back on your question that you might have on situation that you're facing or worries that you might have on how to take charge of your financials. Okay, and as usual, this is just my standard disclaimer because I work for IFAS Global Markets here in JB, Malaysia, and whatever I'm sharing here is really my own personal view and my own personal process, and it doesn't represent that of my employer. Okay, and something that I do, which I'm going to share with you today, which is running through the financial health check process that I do for my own family and also for my clients. And after today, I hope it gives you a better idea. And if this is something, a journey that you want to go through as well, you want to go through with me, feel free to reach out to me as well. Okay. And of course, just a quick introduction of IFAS. If you have never heard of us, we are a company based in Singapore. Actually, our HQ is in Singapore. We're listed on the Singapore Exchange, and basically I work for the Malaysian office, and I'm the one of the financial advisor in IFAS Global Markets, where we provide access to the entire wealth management solution that you might need, from investment to protection to even estate planning as well. Okay. I'll share a little bit more about my own investment philosophy maybe later on, but it has been a philosophy that I have been using for the past, let me count back, 17 years, where 17, 18 years since I started investing in 2007, 2008 during the last global financial crisis, and it has served me pretty well in my investment journey. And this is something that I track my own portfolio throughout the last 1 or 2 decades. And it has been quite a fruitful journey for me. And all I'm trying to do is really share what has worked for me and what has not worked for me. Especially, I have done a lot of mistakes along the way. And hopefully that will be useful for you. Okay, let's get started. We have to, before we get started, to truly understand how to grow our wealth or how to invest. I think the first thing that we should really focus on is understanding our current situation, right? And this is a part I feel that a lot of us overlook. And most of us, when we jump into investment, even for myself especially, I think 2005, 2006, I started investing mainly because at the time I just started working. Of course, investing is something that I have been already learning about during my uni days, just finding ways that how I can grow my personal wealth a little bit faster, because I was trained as an engineer. And I understand that if I come back to Malaysia to get started as an engineer, there is my progression wouldn't be that fast. And I was on the lucky side when I first started coming back to Malaysia and work. Although I landed an engineering job and the salary wasn't that much, I was able to live with my parents for the entire time. So my expenses wasn't that high, and my parents I'm grateful enough that they give me a starting capital when I first get started, and that sum of money basically I invest everything, and from there I trial and error and learn through many mistakes to understand what is important in looking after your own finances and what works and what doesn't work. So before we jump into the real case study that I have prepared for you today, just run through a few very simple concepts. I think this is something that we share previously, of understanding your personal balance sheet, right? This is a key starting point, right? To know that to want to fulfill our financial goals, we first have to take a snapshot of how we are doing today, right now. And to do that, we have to understand both our asset and our liabilities. And this is just a key example of how I do it. Our asset will include everything that we own that we can exchange into cash and liquidate into cash. This could be our, say, investment properties, could be our personal home that we are living in, our investment stocks, unit trusts, bonds, even cash that we have, our EPF, everything will be considered our asset. If you want to go into minute details as well, you can dive deep into even your jewelries, the cars you have, things that you collect that you feel that is going to be valuable that you can exchange for monetary purposes if necessary. Those will all be your asset. And then from there, we will also look into your liabilities. What are the loans that we are having? Your student loan, your car loan, your house loan, your credit card debt, or whichever it is, those are liabilities. And if we subtract the two together, that is what we are looking at, our net worth, right? Our net worth. And that is the figure that we are trying to grow over time. It's no use trying to grow just the asset side of things. Say, it's no real good use if we are constantly just trying to maximize the asset size without understanding how the liability could impact us in the long run, right? For example, if we are someone that is constantly acquiring new investment property and maxing out our loan, maxing out our liabilities from the banks that we can have. Maybe we take even personal loans or swipe our credit card to buy the property, whatever it is, just to chase after increasing the asset size without understanding how our liabilities impact us, then it could, at the end, have very little impact on our real net worth, which is our asset minus liabilities. And to have a solid net worth is something that allows us to reduce stress in our life, and also a key part of staying solvent and a key risk management that we have to look into. So I always use it as an example, like we go for yearly physical exam, right? I think mid last year, I just done mine. And this is something that we should do every year or every other year, just to have a body checkup. And I see it very similarly, right? We take care of our health, we should take care of our wealth as well. And we should really do a yearly wealth examination as well. And this is something, of course, you can't go to a doctor to do it, but it is something that you can do by yourself. Or, of course, you can work with a financial advisor like myself to run through the process with you. So I'll just change my share screen and run through what I'm going to share with you over here. Maybe make that smaller so we can. All right. Okay. I hope you guys can see the new share screen. Let me know if you can see it. Give me a thumbs up, or let me know if you have any question along the way. Okay, so This is basically a software that I use to plan out the financial planning for my clients and myself. I have put myself inside as well, but you don't really need something like this, sophisticated like this, to run through your personal. If you're looking at for your own personal use, you can just use an Excel file. That's more than enough to get started. But in this example, I'll just run through with you a demo account that I have, a dummy account that I created. Let's say this is a married couple, Stanley and Wendy, which happens to be my wife and my own name, but this is just a dummy account that I created. And they have one child, and they are at the age of 28 and 27, much younger than myself. And the first step is really to fill up all the financial details. So to understand their key financial situation, we have to be detailed in understanding where exactly is their wealth stored at. How do we access that? How much do you think it's worth? So running through this example, all the assets that they started out now with about 1.04 million in asset, and this is all the details, right? It includes both their EPF account, both of them are working, and it includes their home, now their property mostly, which is valued at 730,000. Right, this is the assessment that we can put in. They have a cash saving with them in their savings account of about 20,000, and all the others are just different accounts of the EPF. So most of their asset right now makes up of their personal home, a little bit of cash saving, and plus their EPF, because both of them are working. And on the investment side, so what are they investing in right now, and how much is it worth? And we can put in everything over here, including if you have, if you have an art collection, if you have wine collection, or you have an antique car investment, whatever it is, we can list it down, and you can list it down in your Excel as well, and the current value that it is at. What this software does a little bit better than, say, an Excel file is we can put in the expected return. Say we assume if we just keep this asset, it should grow at a certain rate. And this is something that we can put in ourselves just from here. And we can put in estimation that if they're playing stocks and shares by themselves, they can earn it at about 7% a year. Now it's about 60,000. They have a unit trust they have invested in. And if that could grow at 6% a year, that will be pretty good. Now they have about 45,000 in it for himself, and then for the spouse, another 35,000. And they have 50,000 locked-in fixed deposit at about a 3% rate. So those are all the investment that they have. From here, if we want to do a little bit deeper detail breakdown, we can even do a pie chart of how much is in stocks, how much is in unit trust, how much is in bonds or cash. We can even break it down. That I do for some of my clients is the exposure, the exposure that they have in their investment. So maybe their stocks and bonds is mostly in, say, US exposure. Their unit trust is mainly, say, local, and then we can break it down, their exposure to every market that they are exposed to give us a sense of what are the risks that they're facing. Okay, this is just a quick rundown of what you can do with the information that we put in. And then after that, of course, we must put in the liabilities as well. So how much, for them, we see that they only have a personal property, and that has a mortgage of about 580 left. We can put in, at least in this system, we can put in the mortgage rate, how much more that they have to pay down, the repayment from there, and how it pays down over time. We can actually see it in the loan table. Okay. And this is the first part of it, just to understand where is your financial status right now, the balance sheet or of yourself or of your family. And then you can, if you're running through this exercise together with me, you can do it for yourself, or you can do it as a family unit. It doesn't really matter. But the key thing is just this will allows you to give you a much clearer sense of where you're standing at this particular moment. And of course, when we're looking at balance sheet, another part is looking at the income statement. And from a personal standpoint, the income statement is basically all our income and expenses, right? Say, for example, let's go back to here. As for example, if you look at this picture, the society presumption of all this that is being posted on social media is that if the person is able to spend at such a degree, number one is they must be rich, right? And it gives us an impression that if they can afford this, if they can post that they're going on holiday on business class, and they are going to luxurious restaurants for meals and drive a nice car, these people must be rich. But when I look at it, I tend to see it on a slightly different view, which is, wow, these people has very high expenses. So we should always start looking at things in terms of income and expenses, because just being able to spend a lot of money doesn't necessarily mean that we have very high net worth. To build our net worth, the key part of it is actually not investment. The key part is actually having a much larger income from your investment. Having a much larger income compared to your expenses. With that, then it results in having surpluses. And having that surplus, even if you don't do anything and just keep it in cash, over time, if you're saving for the long term, next 10, 20 years, it will continue to grow because you have surplus. But if our expenses and our income is the other way around, it means that we are constantly not growing our surplus, or we're actually eating up our net worth that we already have. So this is a key thing that I think we should start looking at as well, which is understanding, at least on our own situation, what is our income and what is our expenses. And this one, of course, you can also do it on an Excel sheet by yourself. For example, for this example, as a family unit, they're both working. So Stanley is having a gross income of about 5,000 a month. Stanley has about 6,000 per month, and the spouse has a gross income of about 5,000 a month. And they both pay tax, they both pay EPF. This is just the allocation that is calculated from the system. And from the expenses side, this one, it might take, I think this part will be the one that take the most time if we are going to run through this process by yourself. Of course, we can do it based on an estimation, but you can also, especially now when everything that we are spending is digital, is run through digital payment, it's a much easier time for us to track right now. Previously, if we use a lot of cash payment, this might be a little bit hard to track. But for me, on my personal case, my wife actually downloaded all our bank statement, all our e-wallet statement for the whole year, and you can basically put everything in. And because our expenses run through, is not the same every single month, so you can do a whole full year one and just average it out completely. And if you average it out, then you can roughly know how much you're spending, say for vacation, how much you're spending on fuel, on car maintenance, on your house maintenance and mortgages and things like that, for your childcare, of course. So for this example, these are all the things that we run through, including, say, their insurance payment, their income tax, their childcare maintenance, and everything. So a good part is you can see that their take-home income is still slightly more than their expenses, because you can see that although their total income is 160,000, of course that includes EPF and SOCSO and also tax. So if we take all of that out, the take-home pay is about 144,000. It means they should have a surplus of close to 10,000, 11,000 per year. So they're saving roughly about $800 to $1,000 every single month. That might not look like a lot, but bear with me. So that might not look like a lot, but if you look at, let's just here, if they're not doing anything at all with that money, every single year they're just keeping it in their cash account, you can see that that money is also still growing, because number one, we assume that their salary will also grow, and of course their expenses will grow according to inflation. But we can assume, if most of us are working, that our salary should increase slightly more than expenses, slightly more than our inflation. And that means that our cash saving should increase over time, slowly, and increase more and more and more. You can see that even if without doing anything, saving for the next 10, 15 years, they could save $1 million in cash if they keep their lifestyle. The key part here, of course, this is just a simulation. We cannot change how our spending habit changes as our income rises. A key part of assumption here is that we maintain a similar level of lifestyle even as our salary increase. And if we're able to do that, it means our surplus will grow more and more, and our savings should grow more and more. Something that, of course, practically speaking, maybe that's a little bit hard, that as our income grows, we want a better lifestyle, we'll increase our expenses. And that also means, at least from this simulation, you'll see that this also means that our savings rate will not grow as fast. And it can be a huge difference by just showing you the working years. I'm just showing you the working years here. If they are really able to control that temptation of increasing their lifestyle, just by the next 20 odd years of working, they can grow their cash savings to around $3 million for this couple without doing much, without even investing in anything. Let me just go back to, okay. But of course, that is a very, very serious but. It's very, very hard to do in practical terms. And that is why having a regular saving kind of plan to invest would be helping us to create this forced saving. At least in my experience, I realized that even for myself, whenever my cash balance in the bank grows to a certain size, there is a tendency and there is an urge to, wow, okay, there is some cash buffer here, we can spend on some things, right? And a key way of how I resist that to take away that temptation is that I'm constantly always finding new stocks or new funds to buy as investment. So my cash buffer is constantly very, very low. I only have what I need to use. Everything else I have invested them. And in this, this allows a few things, that I control my spending a little bit, right? But I have 4 kids, so my spending is still going to be pretty high. But I control my spending a little bit. And I'm also buying some things, but I'm buying asset, right? I'm using that excess cash that I have accumulated, and I'm buying more asset. At least give me the comfort that over the long term, that asset should grow over time. Instead of if we start having this cash saving and we say, oh wow, I can afford a new car now. And if you buy that car, that is what we call opportunity cost to our money. Because if we use that same amount that we use it to buy a car, if you buy into a good investment, then that investment should continue to grow over time. But that car would almost 100% you will lose out over the long term. Yep. Okay, I digress. But okay, so this is the simulation that we can do for this couple, and this is pretty detailed. You can see that, let's go into now they're age 28, and as they become older and older, you can see that their income and their expenses will change as well. This is because we have already inputted the inflation assumption that they're facing, and also their increment assumption they'll put in as well if they continue to do continue with their current lifestyle. So we can put that in. You can see that at age 38, their expected income and expenses is different from right now their income and expenses. Okay, this is something that I guess the software will help a little bit better compared to if you're using an Excel file, but it's not that big of a deal. So you can still do it on a personal basis, and we can see that as well here their investment, how it grows year on year. You can see now that they are at age 44, that investment should, if they do nothing, from about 190,000 to grow to about 400 plus thousand after this is 16 years. Okay. And now from here, we have done these two things, which is understanding their current status. And what I'm able to help, say with my clients or visualize it a little bit better for me and my wife, is now we can see, are we on the right track? If this is what we are doing, this line would represent our cash saving. Okay, how it grows, and when we retire, our EPF, the EPF is withdraw. What will happen, and then how the couple will spend off their cash saving over time. And it means that if they don't do anything and just rely on cash savings, it should be able to last them to age 84, 80, 83, 84 before they would reach financial difficulty, right? But that doesn't include what they have in their asset, meaning their investment. So let me go to the other one. This is their net worth. So you can see that if they just keep whatever net worth that they have over here, the green one is EPF, and when they retire, they draw down the EPF. What they are left with is just the investment and a little bit of investment and the cash and their fixed asset. The dark blue is their fixed asset, which most likely they will just keep because it's mainly their houses if they continue to stay in it. Okay, and we can do a simulation over here. Say if over time they want to, after they retire, they will also liquidate their investment. Say I run through one possible scenario. If they want to liquidate their investment along the way, how much more does it allow them to extend their savings? So previously, without it, is until age 83, and from the investment that they already have right now, it could extend another 3 years until 86. So you realize that, whatever that they're saving now is still not really sufficient. But what else can we do from this data that we have? Something that we can do is running through their financial goals or their planning of their life. Maybe, for example, they wanted to buy another property. So now they're age 28, they're thinking, maybe they come to me and say that, I'm thinking by next 2 years, I'm going to get a promotion and I want to buy a new property. I want to upgrade my property. Can they afford it? Would it impact their finances? We can run through that scenario as well. Say I set it up already pretty much here. Let's run through the details. Say if they by age 30 they want to buy a property for rental purposes, about 600,000. It's a second property. They have to pay down payment of maybe 30%, and the rest as mortgages. Some of the renovation costs and the possible rental income that they might get as well. So all that put in, you can see that from here, they might have a shortfall. Red color means they will face a shortfall in cash. And this is something that they might need to plan, right? If they want to buy a house at age 30, maybe they have to liquidate their investment during this part just to afford the house. But that also means that they stop the compounding effect of their investment. They will just have that house. They have to make the decision, is it a better trade-off of just owning one house or a diversified portfolio that we have right now here? And which one could be a better fit for them? Okay, but you can see that we can run through this simulation. We can also run through another simulation. Say they want to think about having a second child. They're still pretty young. Their child maybe now is in childcare, 3 or 4 years old. They say, we're trying for another child. How would it impact our the finances? You can see that. Let's run through the assumption that I put in. We can put in whatever figures that we think is more reasonable, right? Maybe the initial cost of the pregnancy costs about 20,000. When the child is out, the extra expenses on the child, the extra childcare on the child, in the future, when the child goes to school, some of the expenses, everything we can put it in. And you can see that it shouldn't impact them too much, generally. So this is the assumption that if they want another child, they should be able to afford it and be able to grow their family. That's great. That's great news for them. Give them a little bit of comfort. But if they have a new child, maybe now they have two children and they're thinking about their future. They're thinking about future. They want to make sure that they can go to overseas to study, to broaden their world horizon a little bit. How would that impact their finances? Okay, we can run through that example. So you can see that over here. This is the first child. We can say when the child will be entering university, what the child want to study. For example, where do we want to send the child to? For this example, let's just say that, let's not go too extreme. Hopefully, they can send their children to Singapore to study. Okay, all these numbers are within the system, but of course we can change it if we feel that we have a more appropriate number. I'll just keep it as default for now. And this will simulate when the child is in university, what will happen to their finances. You can see that yellow, it means that their expenses during this period, their expenses will be more than what they're earning, their income. And that means that they're going to eat up some of their cash balance. You can see their cash balance going down during this period. But the good news is they should still be able to afford it, to send one child to university overseas. But the problem is, if you send one child overseas, the second child would also expect that he or she can go overseas. If not, we will be too biased as parents. So now we have to prepare 2 times for the second child to go as well. If it's Singapore, again here, if it's Singapore, in this example at least, okay, it should still be all right. But let's say, for example, this child, wanted to go somewhere else, like the US. How would that change the expenses? And you can see that regardless of how determined the child might want to go, if without any scholarship, maybe that is not really possible. You can see the huge shortfall for that 4 years if the child is going to US to studies. So that could be something to at least highlight to them that this is something that you need to maybe change the decision a little bit, or we have to start making some plans right now, since your cash buffer is growing during this period, to look into how you can save and invest a little bit more aggressively to save for that possible scenario that you want to send your child to much further place to study. Okay, so all this is something that I've been running through, both for myself and my clients, to run through different scenario and see how it would impact our finances. And I wanted to highlight that to you is because even if we say, okay, if the child is going to a place that looks highly unlikely, but if that is really the financial goal or a dream of the family, right? Then they have to make sacrifices somewhere else, and we have to find places that we can work out, either reducing their current expenses, finding ways to increase their income during this period, and working out a financial investment plan so that it could become a reality, if that is something that is so important to the family, that is the key dream of the family, that they want to achieve this. Then we can work around to see if there is a slight chance that it can be possible. Okay, so this is just a few scenarios that I want to run through with you. But the last one, before we jump back into the presentation, and of course, if you have any question along the way right now, you can pull up the chat box and let me know if you want to discuss it a little bit further. But the last example or scenario that I want to share with you is just running through retirement, right? So for example, right now, they're both working a corporate job, and they're expected to do well all the way to retirement. And then they're going to spend all their EPF money along the way. And it should last them until the age 83. Theoretically, it should be fine if they don't want to leave anything for the kid, or they just want to leave the house left for the kid. But you can also see that there's not much of a margin here. Say, for example, if they are in such good health and live more than 83 years, what will happen to them? And if they don't want to burden the child, then they have to plan for it. Even if the current investment that they have right now, if they liquidate everything during retirement, they are still just extending that saving for another 3 years. It is still pushing it, right? You can see that it's pushing it a little bit. Could go into scary territory. Another way that maybe we can look at it and think is, okay, why not? There's two possible ways. is right now, as the cash saving is growing, we can create a regular investment plan to run through so that they are saving and increasing the investment during this period. And when they retire, then they will have a much bigger pile which they can spend. That's number one. Or number two, when they get all their EPF money, maybe they can put it into an investment, because theoretically speaking, after they retired, till the time where they kick the bucket, we have to give roughly about another 30 years of time frame. That's actually a pretty long time frame, and you can definitely invest that money for the long term over the next 30 years. Say, for example, if we want to run through that scenario, as once they get their EPF money, then we'll have an investment plan that they invest in a diversified part and then slowly draw down that investment over time. So I run through one such example. Say, for example, if they invest in something like a managed account, where it's straight away a diversified portfolio that they put in, and then from there they draw out a monthly dividend. They just cash out a monthly dividend. I put here a monthly dividend of 0.5% times 12. That's taking out 6% a year of that money. Taking out 6% of the year of that money over time, you can see that they should still be able to maintain the investment that investment portfolio if they're just spending the dividend. So if we run through such an example, let me click it and simulate it. Right, this will appear very weird because they will get a big chunk of EPF money, but then next year they will spend it all, as in invest everything. So let me just change the chart. Yep, to a log chart, and it should smooth it out. So you can see that extends their investment horizon and their savings by until age 96, roughly about 96. And if we include that investment previously that they have, the 190,000 right now, they should have enough to last them to age 97. Of course, everything that I say here is just on theory, right? But there's a pretty good buffer. And it's definitely a much better margin of safety compared to not doing anything. So these are just things that we can run through, and then we can start planning once we have the data. And you can see that everything starts at the beginning of what is our current financial status. Without understanding this situation right now, it's very, very hard to plan out what could happen in the future. And today, I'm only spending the time to talk about financial planning in terms of our investment and our cash management. I'm not talking anything of, say, protection of insurance, or what happened if one of the partner pass away, one of the partner fall sick. Maybe that's a story for another day. But just from this, you can see that there's a lot of things that we can talk about. And I encourage you to get started, on this journey. If you have not tried it before, try it yourself. If you have not had this conversation with your spouse or your family before, try to have that conversation, see how it goes, and run through this simple exercise. It takes me maybe half a day. Okay, it takes about half a day for me to run through everything for my household. But I would say that from that conversation, it gives at least my wife a little bit more peace of mind that we're still okay on the right track. and not to be, to at least have a clear understanding of where you stand in your own finances. Let me think if I miss out on anything. But at this moment, if you have any question, feel free to pop up on the chat and let me know. I have a comment from Gong Chu Guok. Thank you for the comment. And I don't like people investing on my behalf, therefore no unit trust for me. Okay, fair enough. Yeah. And if you have, you prefer to do it yourself, and you have been seeing great result, that's perfect. Let me just share back the other chart. Okay, so that's just a quick not introduction, just a quick run through of a typical process that I do when it comes to fully understanding our financials and how we can put in more accurate action plan rather than just coming and say, what should I invest in now? I want to earn as much money as possible. To me, that doesn't serve any purpose. Without a clear financial goals that you want to reach, it's very impossible for us to invest for the long term. And if we don't invest for the long term and we're just trying to pundit in stocks, it's very, very hard to grow true long-term wealth in the stock market or be it in any asset classes. So you can see that from the example just now, once we understand our financial status, a key part is maybe the best action that you can do to boost your financial situation is actually looking at how you can increase your income and reduce your spending. If just from savings, cutting down on expenses, that will be actually the fastest way to grow your wealth. And then after that, you can think of how do I invest that surplus. And different people might be in different scenario. Although I myself, I'm a financial advisor and I only earn if my clients start investing. But if I have talked to a few clients where I feel that they are not in the position yet to still need to sort out this first part of their finances first. I rather spend a little bit more time to help them to sort out this issue first before we even talk about any investment. And after that, of course, we have to look into your liabilities as well on how should we manage that. Should we be thinking of trying to reduce that debt as fast as possible, or we have enough buffer to maintain that debt for a while? Okay, we run through a few scenarios just now. If kids want to go to university, not this one, maybe this one we can talk a little bit more on the next time. But the key things here is by running through this experiment, you'll be able to have a clearer idea of finding the preferred path for you on how you want to plan out your finances, and also understanding how you can avoid the big risks in your life. If you have too much liabilities, maybe the best thing is to try and cut down and pay down those debt first to avoid the big risks in your life. Okay, so that we can have a carefree and more comfortable retirement. But the key thing here is really we have to get started. This is something that I share, I think, in the last few presentations as well. To me, investing is not the most important part of the financial plan process. The biggest part is really to understand where we are and where we are going. And through understand your current status and your current need, and then only then to think about where on which asset class we want to invest in to reach that particular goal that you have, instead of just going for things that could potentially give you the maximum return. Right? I hope you understand what I'm trying to explain here. Because when it comes to investing, most of the time when I interact with someone who hears that I am in the investing line, they always ask for what's the best thing I can invest in right now. But there's not a straight answer to that question, because what is suitable for me might not be suitable for you. And in many cases, we don't really need to go for the highest return or the highest risk kind of asset classes. And only by understanding your own current situation and your finances now, then we know that how much risk we can really take. Because when it comes to investing, nothing is risk-free. It's not risk-free. We go into a particular investment or particular exposure, we are taking on that risk. And hopefully we get rewarded for taking on that risk. But there's still a risk. So only by first understanding our financial status and current situation, that we are sure that we can take this risk, then we can go into that investment. I hope it makes sense. So from there, we can build up a solution to create the right exposure to make sure that these are risks that you can take that will not affect you too drastically, even if it fails. And I'm saying this because there's no such thing as investment that you will get profitability all the time. Regardless, even until today, I have been buying and selling stocks for the past 17, 18 years. Every single year, if I track down all my position, every single year, I would have maybe 20 to 50% of my position that I'm losing money on. As a basket, it might grow, it is growing over time. But every single year, if we go down into detail, I can assure you there's not a single year over the past close to 20 years that year, every single stock that I have is in the positive realm. I have never had that. And that's because that's basically the name of the game. Investing is a game of probability, and we have to understand that we win some, we lose some, and be okay with that. Okay. And then from that, we will monitor and we review, right? The example that I've gone through, running through your balance sheet and your income, that's not something that we just do for once and then we not look at it again. It's good if we do it year on year on year. Say, for example, right now, I have a goal that I want to grow my family net worth at, say, 10% a year. And I'll do that balance sheet test every single year to see if we are on track. Of course, because most of my asset I'm investing in the stock market, so it's going to be volatile. But over, say, a few years period, I hopefully want to see that progression to know that I'm on the right track. And that is a great monitoring and reviewing stage that you do. Okay. I think I mentioned this before. The investing can be scary, and it is scary. And we will go through crisis. But we have to realize that the only people that can afford not to invest are people who has already reached their financial goals. They already have everything that they want in life, and they can afford to just keep all their money in cash because they don't need to invest. Right? But if you have financial goals that you have not realized yet, like myself, then a possible way to reach that is to start having an investment plan. This is just another example that, I talk about matching allocation, like on exposure to when we're planning out their investment. This is something I plan out for my clients as well. How much you want to be exposed to, say, the US market, to the China market, we can work out that allocation. And I wanted to highlight is we actually don't need a big part, a very very big sum of money to invest. What we really need is a long time to invest. If we can stay invested for the long time, we can see the compounding effect to take into effect. This is just a simulation I started. Say if we start from a portfolio of just 100,000, right? A portfolio of just 100,000. If that person can grow that portfolio at 8% a year, that amount can grow to $2 million by the end of 40 years, right? 2.3 million. But if the person can grow that at, say, 10% a year, just that 2% difference, to us, every single year, maybe 2% difference is not that much. But if that 2% is to compound for a very, very long time, you can see that a 10% return actually give you $7.8 million at the end, which is more than double. And if you add another 2%, that amount can grow to like 16%, 16 million in the future. But of course, to consistently do a 12% return every single year, I would say it's quite a difficult feat. It's quite a difficult feat, but within, say, an 8% range, I think it's more than possible to do it. Okay. Let me see if there's anything else important that I want to share with you guys. Okay. Before I end, this is just a quick spin-off section that I always tend to share, which is something that I have been working on or reading up, find interesting over the last few weeks. And this week, I wanted to share with you guys this book called Deep Work by Cal Newport. I'm not sure if I shared this before, but I think it's so important that I want to share it with you guys again. And this is just a book for us to find some guidelines on how we can create time for deep focus work, especially in my line of work where I like to do my own research. There's just long stretches where I'm just doing work and researching, and that's important. And especially in today's world where it's so easy to get distracted from our phone notification on just checking on YouTube or Facebook, how can we create this environment and a routine for us to have the time to do focus work? And I think that only by doing spending more time a little bit on deep focus work, or regardless of things that is related to your work or just on your interests, where you find time to expand and research on your own interests, I think that will give us a more fulfilling life over the long term. And if there's something that interests you, you could check that book out. And again, this is just a summary of what are some of the things that iFast Global Market give you access on. We are a tech platform together with me as advisor that give you access to almost all the possible investment asset classes that you need to create a diversified portfolio from your traditional unit trust, bonds, our company-owned managed account, your cash management, right? We offers interest rate for all currencies, even access to offer stocks and bonds all over the world. It is done through our platform. And before I go, I just want to share one short most of what I talk about online or sharing on my content is really about investing. Um, of course, that is something that I have spent a long time researching and trying to understand uh, over the course of the last 20 years. But I very early on I realized that investing is really not the key, I would say, key focus for myself in this financial journey at least. I realized that I am always more interested in understanding the entire financial process, how we take care of our own finances, that process of financial planning. And I feel that that is much more impactful on an individual basis. Because when I first started out working, I remember a story. I remember there was a time where I have an uncle that he has been working for MNC for a long time, and then he started to come out with a group of friends to start a business. And I think this was a time when I only started working 2 or 3 years in the work market, and he has a falling out with his business partner, and he has a panic attack. Right in the middle of the night, he called me and my father to send him to the hospital. He had a panic attack, and at that time, I really don't understand why he has a panic attack. But later on, my dad asked me to help him out to talk to him a little bit about financial planning and just understand his situation at the time, because I was very into investing. And when he was telling me his financial situation, that he was like $50,000 in credit card debt, and still having the mortgage and having the car loan, and now that he's lost his job because he has a falling out with his business partner. Basically, he was living paycheck to paycheck every month, and now he was in this dire situation where he don't know what to do, and that makes me understand why he has a panic attack, and helping him, work through this process. Of course, I can give some advice on how he can get out of the situation, but if he wants to follow through, it's still up to him. But at least understanding this part made me realize that that is the more meaningful and more impactful part of the process in the whole financial journey of a person. Rather than when I was young, I started researching on how to become a fund manager, because that's what everybody aspire to be, right? Because when we are good at investing, we think that we can be the best. We can fight with the grandmasters of the industry. And I run through. I went to Security Exchange. I went to both Singapore and Malaysia to find out the requirement to become a fund manager on your own, and run through all the process. But then I realized that, okay, number one, maybe I'm not as good as at the top of the game. And my own portfolio, yes, is beating the market, but not by much. If you compare it to, say, the S&P 500, if you're talking about like just 10+%, 11-12%, it's good, but it's not mind-shattering. And number two, I realized that I'm not sure if I will find satisfaction in such a work where the only target is trying to beat the market, but it doesn't mean anything. Whereas, which is a key part of why I end up joining iFast, is that I feel that by working through the entire process, especially with clients who want to go through this process with me, it's going to be a much more meaningful work, rather than just chasing that return, and you're not even sure why you're chasing it for, just to play in the game. This one, at least in the work that I do now, I can see more tangible impact on different people that I touch base with. And so it's a long-winded way of saying that I do see IFAS as my life's work, and which is why if you're also interested in joining this journey with me, I'm happy to speak with you, and you can scan this QR to have oops, give me a minute. You can scan this QR code to set up a Zoom session with me, or you can contact me on my email. And I'd like to leave with you guys with a quote from Marcel Proust. Is a writer from France a long time ago, and I think it's relevant for today's, which is: the real voyage of discovery consists not in seeking new landscape, but in having new eyes. So as long as we have a different perspective about things, we can see new and different possibility. And hopefully that will be useful for all of us. Thank you so much, and I hope you enjoy this session. And thank you so much for Chu Kwok for your comment. I think you make some comment on dear Mr. Trump as well. Always fascinating to read the news nowadays. Thank you so much. Happy Chinese New Year, and if you're praying tonight, happy praying, and all the best for everyone. Till we meet again, my name is Stanley. Invest safely.